Lucid Motors stock is falling right now after they reported very poor second quarter earnings and gave some disappointing updates and news about the business. In this video, we will do a deep dive into some of the issues facing the company and look at why the market is selling Lucid stock. Most of the negative earnings reaction came from the surprise news that Lucid was slashing their vehicle production estimates for the year in half. The company had been giving guidance for production of 12,000 to 14,000 vehicles, but they lowered their forecast to only between 6,000 and 7,000 vehicles for the year. Lucid was very vague with details about the production issues they were facing, and simply attributed the production cuts to, quote, supply chain and logistics challenges that limited our ability to ramp our production volumes, a challenge compounded by limitations of our logistics systems, end quote. This is not the first time Lucid's production estimates have disappointed investors either, as this is actually the second time Lucid Motors has cut its production forecasts for the year of 2022. The company had originally been projecting that it would manufacture 20,000 Lucid Air vehicles this year, and its forecast is now for well below half of that original number. Lucid has only managed to produce 1,405 vehicles so far in the first half of this year, as they disclosed in their earnings release. The company said they are trying to fix their production problems by bringing their logistics operations in-house, restructuring their manufacturing and logistics organization, and adding to their management team. It's not entirely bad news for Lucid throughout the entire earnings report, as they did highlight how they have over 37,000 customer reservations for the Lucid Air vehicle, which represents potential sales of approximately $3.5 billion for the company. This strong number of reservations illustrates that there's very strong demand and consumer interest in the Lucid Air. However, the strong demand won't matter if the company can't fix its production issues so that it can actually meet that demand with supply. $3.5 billion in reservations in the sales backlog is great, but if they can't supply the cars, they will never be able to claim that money. These production issues Lucid is facing right now are also a serious problem for the company's future, because it's causing them to fall behind their competitors as the electric vehicle sector becomes more and more competitive. The electric vehicle market is rapidly growing right now, and according to Kelley Blue Book, Americans bought nearly twice as many electric cars in the first quarter of 2022 compared to the first quarter of 2021. But Lucid is not able to fill any of this rising consumer demand for EVs while it's having these major production issues. These manufacturing problems are allowing their competitors to capture more of the electric vehicle market share, while Lucid's production flounders and it fails to make its vehicles available to consumers and the rising demand. Not only is Lucid losing market share as they fail to manufacture their vehicles at a large scale, but they are also quickly burning through their cash reserves. In the second quarter of 2022, Lucid brought in a little over $97 million in revenue, but the cost of that revenue was over $292 million, meaning that Lucid Motors had significantly negative gross margins and actually lost money with every single car it sold. Tesla has a very expensive valuation in its own right, but for context, Tesla does have positive gross margins of over 25% and has had positive gross margins for well over a decade. The negative gross margins on Lucid's cars make the company a very risky investment, as they actually lose more money with every single car they sell. These losses were made much worse by Lucid's $364 million in operating expenses. This gave Lucid a total loss of operations in the second quarter of nearly $560 million, which is a massive loss. The company does currently have a large amount of capital with $3.15 billion worth of cash and cash equivalents on its balance sheet as of the end of this quarter. But if Lucid keeps losing over $500 million in operations every quarter, the company will quickly drain these cash reserves, and there's a significant chance the company will have to raise capital to continue funding its operations for the business. This poses a notable risk for Lucid's shareholders, because the company may have to do a share offering to raise cash. This potential offering of additional Lucid stock shares would dilute the existing shareholders, as they would own proportionally less of the company with the increased share count. For all of the significant problems Lucid Motors has with its production and profitability, Lucid stock still has a market cap of nearly $31 billion at the moment. While this is a far cry from the nearly $970 billion market cap valuation Tesla has at the moment, this still gives Lucid Motors a crazy valuation with a price-to-sales ratio for the trailing 12 months of over 170. For context, this means that for every $1 in sales Lucid has, stock market investors are currently paying $170 for that single dollar in sales. For reference, Tesla trades at a premium valuation of its own, in my opinion, and even it only has a price-to-sales ratio for the trailing 12 months of 15.71, which is significantly lower than the premium that Lucid trades at. I would argue that the reason that the market is placing such a premium valuation on Lucid Motors stock is because of the major success of Tesla stock over the past decade. Investors don't want to miss out on the next Tesla. However, the circumstances surrounding Tesla and Lucid are very different. Tesla IPO'd at under a $2 billion market cap and grew its company to the premium valuation it has today by building a significant advantage in the electric vehicle space as the first major mover. This first mover advantage and moat that they built is why Tesla had roughly 75% of the electric vehicle market share in the first quarter of 2022. Lucid, on the other hand, has almost no market share and IPO'd at over a $40 billion market cap simply because investors are excited that it could be the next Tesla despite its much worse fundamentals. If investors insist on having exposure to the electric vehicle market, I believe they would be better off buying Tesla, since it's currently profitable, is not facing major production issues, has positive gross margins, and has a much more reasonable price-to-sales ratio. With that being said, I still think Tesla is overvalued in its own right, which I made a separate video on that you can find linked right here. Given all of the issues currently facing Lucid Motors, it seems likely that Lucid stock will continue to be under pressure if the company doesn't control its cash burn and get its production issues sorted out quickly. Having negative gross margins on every car it sells is also a major issue that will prevent Lucid from ever reaching profitability until it can get positive gross margins. Given the significant amount of money the company is currently losing in the meantime, it seems very risky to think the company can sustain itself until it can reach that point of positive margins. With that being said, these opinions are my own, and you should be sure to do your own research for your investment decisions. Be sure to let me know your thoughts about Lucid stock and their recent report in the comments below, and leave a like on the video and subscribe to the channel for more finance and investing content. Thanks.